Welcome back to the Deep Dive. Today, we're getting into the latest numbers from Penguin Solutions, Inc.
Right, a company really pushing the envelope on enterprise AI.
Exactly. And we want to cut through all the data, skip the dense jargon, and really pull out the insights that matter for you, our listener.
Yeah, the goal is to give you a quick but, thorough grasp of their Q3 2025 results. What's the real picture?
We've got their report right here, Q3 financials and the outlook.
And we're going to dissect it, look for the highs, the strong points, but also maybe some of the subtle dips.
Get that complete picture right, especially for a company betting big on AI.
Absolutely. We'll unpack what it all means, not just for them, but maybe for the broader AI scene too.
And this is really for you listening.
Yeah.
We'll flag the surprising bits, the crucial takeaways, keep it clear.
Because understanding these reports helps you connect those big trends like AI adoption to, actual company performance.
So let's jump in.
Let's do it.
Okay, starting with the good news. And there seems to be quite a bit here for Q3 2025. Revenue was up.
Yep, hit $324 million. That's a solid 7.9% increase compared to last year.
Pretty healthy. And what about earnings? I saw the non-GAAP EPS number looked strong.
Very strong. Non-GAAP diluted EPS jumped 25% year over year, came in at $0.47.
25%, wow. And operating income?
Also up nicely. Non-GAAP operating income increased 15%, landing at $38 million.
So those numbers, that EPS jump especially, what does that tell you beyond just the headline figure?
Well, it suggests they're not just growing the top line, they're managing costs better, getting more efficient.
And that non-GAAP part, just to remind everyone.
Right, good point. Non-GAAP means they've adjusted the earnings, pulling out certain costs like maybe one-off acquisition expenses or stock-based compensation. It aims to show the core ongoing operational strength.
Gotcha. So it's a clearer view of the underlying business trends.
Exactly. And that 15% rise in operating income reinforces that efficiency story. Profit from the core business is climbing.
And it looks like they feel pretty good about things going forward, too. They raised their outlook.
They did, yeah. Bumped up the full-year non-GAAP diluted EPS forecast. The midpoint went from $1.60 up to $1.80.
That's quite a jump in confidence.
It really is. Raising guidance like that, it usually signals strong internal belief. They think the momentum's going to continue.
But I guess, is there ever a flip side? Any reason to be maybe a little cautious when you see a company raise guidance like that?
Yeah.
Especially in a fast-moving area like AI?
That's a smart question. You always wonder, is it based on a few huge deals that might slip? Or is it truly broad-based strength?
Right, something for you listening to consider the source of that optimism.
Mm-hmm.
Now, the really interesting part for Penguin Solutions, they're calling out early-stage enterprise AI adoption across various vertical markets.
Yeah, and that's the key long-term story, isn't it? AI isn't just talk for them. They're seeing it start to happen with customers.
Seeds being planted, potentially huge growth down the line.
Exactly. Fertile ground.
And you can see hints of that in specific segments like integrated memory revenue. That number was huge.
Oh, yeah, it soared. 42% growth year over year, hitting $130 million.
42%. So integrated memory for Penguin, that's like the high-performance stuff for data centers, right? Critical for AI.
Precisely. High-speed, high-capacity memory solutions, the kind you need for heavy-duty AI training and inference. That surge suggests their AI strategy is definitely driving demand for related hardware.
So is that mostly new customers buying this stuff, or are existing ones just buying more? Does the report give a sense of that?
That's a really good nuance to pick up on. It doesn't break it down explicitly in the headline numbers, but if we look at the Q&A commentary...
Oh, okay. What do they say there?
Well, the CEO, Mark Adams, mentioned 5 new customer bookings specifically.
5 new ones, okay.
And significantly, it's a mix hardware, software, and services, which plays right into their whole integrated solutions approach.
Right. They want to sell the whole package.
Exactly. He also mentioned the sales cycle for these types of deals is typically long, like 12 to 18 months.
Wow, that's quite a lead time.
It is. Hardware revenue gets recognized mostly upfront, but the software and services revenue gets spread out over the contract term.
So that highlights the patience needed in these big enterprise deals, especially cutting-edge stuff like AI infrastructure.
Absolutely. And why that integrated approach is so important. You build deeper relationships, become stickier, harder for a competitor to just swoop in.
Makes sense. And what about partnerships? I saw the SK Telecom and SK Hynix deal mentioned. How big a deal is that strategically?
Seems very strategic. The CEO emphasized it's way more than just a financial investment. They're already seeing wins, he said, particularly on the memory side, which you'd expect with SK Hynix involved.
Right.
But they're also looking at system-level products together, exploring AI data center solutions, and it's global.
So it's really about building an ecosystem, not just selling parts.
That's the impression, yeah. A deep collaborative play.
Okay, so lots of positives, clear strategic direction towards AI.
Yeah.
But no company report is perfect. Let's look at the other side. What were the areas of concern?
Right. Got to look at the full picture. There are a few dips. Advanced computing revenue, for one.
What happened there?
It came in at $132 million for Q3. That was actually down from the previous quarter and down 9% compared to last year.
Okay, why was that?
They cited the timing of a major deployment. Now, advanced computing, for our listeners, that's usually their high-end servers, the specialized gear for complex stuff like, well, AI training or big research projects.
So timing, does that just mean delayed, not canceled?
That's generally the implication, yes. A delay, not necessarily a lost deal forever, but
That just still hits the quarterly number.
Exactly. And it perhaps signals that these large, complex deployments can be a bit lumpy or unpredictable in their timing, adds a bit of risk to forecasting.
Okay, what else? Margins.
Yeah, non-GAAP gross margin dipped slightly. It was 31.7%, which is down zero point 6 percentage points from last year.
And gross margin, that's profit before things like R&D and sales costs.
Correct. Profit on the actual goods or services sold. That slight dip, while small, could suggest maybe rising component costs or perhaps some pricing pressure, something to watch.
Got it. Any other segments showing weakness?
Yes. Services net sales were down 3% compared to last year's Q3, hitting $66 million.
Okay.
And optimized LED revenue was $62 million, which was down 4% year over year.
Why the dip in LEDs?
That one they specifically linked to increased costs and uncertainty related to tariffs on products coming out of their facility in Huizhou, China.
Ah, so direct hit from tariffs and maybe cost inflation there. Geopolitics impacting the bottom line.
Precisely. It shows how these broader economic factors can bite into specific business lines.
And didn't they also mention ongoing supply chain issues more broadly?
They did, yeah. Ongoing supply chain constraints impacting the ramp-up for both existing customers and new projects.
So that sounds like a persistent drag, not just limited to LEDs.
Seems like it. And while, tons of companies are dealing with this, it definitely caps their ability to fully meet demand and grow as fast as they might otherwise.
Right.
And just one other point of caution, some third-party analysis, like from Guru Focus, apparently flagged 3 warning signs related to Penji's financials.
Oh. Did the report say what they were?
No, the earnings report itself didn't detail them, but those kinds of flags from external analysts usually point to things investors should maybe dig deeper into. Could be inventory levels, debt metrics, cash flow consistency, things like that.
Okay, so another layer to consider. Let's switch back to financial health, though. Despite those pressures, their cash position looks pretty solid.
Oh, yeah. Very solid. They ended the quarter with $736 million in cash and cash equivalents.
That's a healthy cushion.
Absolutely. And their cash flow from operations was strong, too. $97 million generated in the quarter.
So for you listening, having that much cash and generating more gives them a lot of stability and flexibility.
Exactly right. It's like having a strong financial immune system, as you said earlier. It helps weather storms, fund R&D, maybe even make strategic acquisitions in areas like AI.
And it looks like they used some of that cash to buy back stock.
They did, repurchased about 1.8 million shares for $30 million during Q3.
What does a share buyback typically signal?
Usually it signals that management thinks the company's stock is undervalued. They see investing in their own shares as a good use of capital, which implies confidence in future prospects.
Okay, so we've got this interesting mix then. Strong growth driven by AI and memory, good partnerships, solid cash position, but also segment declines in areas like advanced computing and LEDs, margin pressure, supply chain headaches, tariff impacts.
It really paints a picture of a company navigating a very complex landscape, doesn't it? You see the huge potential, the AI tailwind, but also the very real operational and external challenges. Quick note on operations, too. Their inventory was $184 million, about 36 days worth. That's actually pretty efficient, suggesting decent inventory management despite those supply chain issues.
So managing what they can control, even with external headwinds.
Seems like it. It highlights that even with great overall numbers and a hot market like AI, it's never smooth sailing across the board. Specific parts of the business face unique hurdles.
That plane in a hurricane analogy you used earlier feels apt. trying to upgrade the engine mid-flight?
Yeah, something like that. It really shows this balancing act, investing aggressively for the future while dealing with today's very real operational friction.
So wrapping up this deep dive on Penguin Solutions Q3, it really does feel like a snapshot of the tech world right now.
Totally agree. High potential, especially with AI, strong partnerships driving things forward.
But tangled up with supply chains, segment-specific slowdowns,
Yeah.
even geopolitics like tariffs.
A company clearly investing for that AI future, but bumping up against some present-day hurdles.
Okay, so here's a final thought to leave you with. We heard Penguin Solutions has that long sales cycle for new enterprise AI customers, 12 to 18 months.
Right.
And they rely heavily on integrated solutions, deep partnerships, especially for this complex AI data center stuff.
Mm-hmm.
So what does that combination, the long cycle, the need for integrated solutions, really tell us about how ready and how willing big companies actually are to invest heavily in cutting-edge AI right now?
Interesting question.
And maybe what does it imply about the real timeline for a full-blown AI revolution across the enterprise? Could it be a bit slower, more complex than the hype suggests?
Definitely something to ponder. Food for thought.
Something to chew on until next time.